Hi folks, this is Doc Severson for the TheoTrade report for Thursday, December 22nd. Now in tonight's report, I want to talk about multiple time frame analysis. So I know what you're thinking, why on earth would you complicate things by putting up more charts than one? Well, the answer is to understand context of what's going on. Now, what does that mean? It sounds like one of these sort of evasive answers like context. What are you talking about? Context gives me sort of the overall landscape of the price and what it's doing by keeping my eye on the larger time frames out here, such as the monthly chart or the weekly chart. What I see with a daily chart, people that only focus on the daily chart, is that price will be going along and doing its own thing, and they sort of get into sync with what's going on with it, and all of a sudden we get a big move that seems to come out of nowhere. And people are shocked by this and they don't understand. Or when price does go through a big move and all of a sudden shifts character into corrective action. Again, that comes as a big surprise to them. And that, I believe, is because they don't have any kind of view into the context of the weekly or the monthly, or, even this can be taken into the context of day trading. If you're trading off of a signal chart, which is maybe a 1 or 2 minute signal chart, keeping an eye on something that's a larger time frame, such as like maybe a 60-minute chart, and understanding what the 60-minute chart is seeing. So the real challenge here is to understand how to plug all the different time frames together, how to put all these pieces together of this puzzle so that they make sense to you. Because most of people that say, okay, I need to do multiple time frame analysis, will just jam on some other random time frame chart, and all it does is take up real estate space. They don't know what they're looking for. They don't know why they have a second chart up there, and eventually it just goes away and they go back to the daily chart or whatever current signal chart that they're working off of. So I have some very simple rules that will allow you to kind of keep this stuff glued together, if you will. One of the first rules that I have is that when it comes to price action, larger time frames will dominate the trend. Okay, no surprise here. You probably heard this before, but maybe you haven't seen how to put it into action. Larger time frames dominate the trend. So in other words, if you have a monthly chart trend has got a lot more momentum and a lot more power than a daily chart trend. So this is like the USS Enterprise cruising out there at flank speed in the Pacific Ocean. Maybe it's doing something like 30 knots. Well, it's not going to just turn on its keel and just immediately flip around if it has to reverse. It's going to take a long time to reverse. In this case, it may take months to actually show a reversal on the monthly chart. Now, how can you use that information to understand better how to trade the daily chart? Well, what this is going to take the context of on the daily chart is these monthly trends. When these monthly trends kick into gear, they are very powerful and they don't reverse very easily. So you can expect to see pullbacks along the way. And of course, on a daily chart, every pullback that comes along is, oh my gosh, here it comes again. It's 2008 all over again. Here it is. It's 2008 all over again. It's 2008 all over again. Right? You're going to get this reversion back to the mean, back to this general monthly trend all the time. Right? So this can help you keep on the right side of the market as if you just understand that larger time frames dominate the trend, whether it's the monthly chart, the weekly chart, all the way down to the daily chart, right? So these have parent time frames to the daily chart. So what I would do if I were you, if you're not using multiple time frame analysis right now, is don't try to put up 3 or 4 charts and then try to pretend that you can glue all this stuff together. It does take a while to do that. Just put another one up there. And I like this fractal relationship of the factor of 5. So there's approximately, there's exactly 5 days per week. So that factor of 5 works out here. There is approximately 5 weeks per month, give or take, right? Work with me here. It's about 5 weeks per month. So that factor of 5 is maintained. If I want to, I can even go down in time frame. I can go down to a 78-minute chart if we're using the cash session of 6.5 hours. So just stick with 2 for now. Stick with 2. If you're traditionally trading the daily chart, then just add the weekly chart as your larger time frame. Ultimately, you'll eventually want the monthly chart on there as well too. I find that this combination here works particularly well between the monthly, the weekly, and the daily. And that leads me to my second simple rule as it relates to price action. Okay, the second rule as it relates to price action is kind of the converse of the first rule. The first rule being that the largest time frames dominate the trend. The second rule is reversals start from the smallest time frames and then they propagate upward. Okay, kind of the opposite of the first rule. So a lot of us start looking at this monthly chart and say, wow, this has got to reverse here. This has got to reverse. Can't wait till this monthly chart reverses. Boy, that's going to be some opportunity. Well, remember what I said earlier. Rule number one is that when these trends get going, they take a long time to reverse. So don't look at this and look for a reversal here. Don't even look at the weekly chart and look for a reversal here. It will happen from the inside out. You get sick one cell at a time until ultimately you have a lot of cells that are sick or catch virus, right? So what will happen is the smallest time frames will start a reversal process. That'll start out with a daily chart. Say, for example, not that I'm calling for a reversal, but this is what it would look like. The daily chart would pull back and then bounce back up again because, again, as we've said, the mean reversion in this case is still to the upside. But what would occur here is that a lower high would be set up of some type. A lower high would be set up and then another lower low. And we now have a change in polarity to the downside with the daily chart. Now it's working to the downside. Now, how is this going to relate to the weekly chart? This is just going to show a pullback on the weekly chart. This is not a reversal yet on the weekly chart. What would have to happen for that to occur is we'd have to have a bounce back up again on the daily chart, and then that fail, and then we have a lower high and a lower low on the weekly chart. This is just going to look like noise so far on the monthly chart. But this is how reversals start from the inside out and they propagate from one time frame to the next in terms of size. So if you're constantly getting caught flat-footed by this market, just one surprise after another, perhaps what you're missing is a little bit of structure that'll allow you to understand, again, that word, context of what's going on and how the price movements fit inside of that context. This is going to give you a much better view and a much more consistent view into the markets where you're going to be more proactive and you're going to be expecting certain movements instead of chasing down the train tracks after them after they've already left the station. That's it for tonight's report. Thanks for listening, folks, and have a great holiday weekend. Take care.